Good morning. This is Trader72. Welcome back to my YouTube channel. I hope you are all well and had a tremendous weekend. It's a nice little start to the week here in London. Fairly sunshiny and good to be back after a couple of days rest. I hope you we will talk about weekends in a bit anyway on the back end of this. But without further ado, let's move straight to the point about Meta. And is Meta worth a punt at this moment in terms of buying at the share price it's at the moment? Now, I'm going to do a quick, a medium quick analysis on Meta and its current situation. For some of you may not know, who might still be looking at it for various different reasons, and for any new retail investors out there, and a process that I tend to look at before I buy into any company. It's really about marrying the story and the share price together, and if it all makes sense and it all falls in place via a criteria that I abide to, which is obviously value investing and intrinsic price and the margin of safety, if we can put all this together with a company that has strong fundamentals, low debt, that it's what it's all about. So I decided to do a quick analysis on Meta, which, like I said, has fallen recently by about 20% off its highs, and I think it's really a decision for you guys to make. This is only an advisory. Please do not just buy on the back end of this analysis. Make your own due diligence, of course. So Meta, as you can see here, is an incredible company. It's been around for the last 20-30 years. Obviously, it really started with Facebook through Mark Zuckerberg, obviously the owner. It has obviously expanded since then, like most of the big 7 tech companies. It has AI glasses, Meta Quest, apps and games, and so forth. A very impressive company indeed in terms of what it's expanding into. Launched actually, we go on 2004. It changed the way for people connect, blah, blah, blah. We all know about apps, and also WhatsApp, which obviously most of us still probably use. Well, I don't know, some of you, maybe you younger ones, maybe not. I still do as an older person. So it obviously has expanded quite naturally since 2004. And it's obviously got Instagram there, WhatsApp, and it's expanded massively with its also AI glasses recently, and the AI world they are in. So let's go without further ado. What does it actually do? We all know what it does, but I'm just going to recap it really quickly. It owns Facebook, Instagram, WhatsApp, 98% of revenue from advertising, which is why it's so attractive for a lot of big time hedge fund managers. Targets ads better, increases engagement, and that's kind of been the bounce back really after Facebook went through a bit of a wobbling time. It has added the obviously ad spend, the ad revenue on the actual site, and it's all AI based. So this is obviously helping the site to make more money. It has over 3.58 billion daily users. I will say that again, 3.58 billion viewers a day. It's a staggering amount. And obviously it has on the other side, the VR, AR, smart glasses, AI infrastructure as mentioned. The main profit driver at this moment is obviously a high, super duper gross margin of, sorry there, my voice went a bit, 80% of gross margin. It's a staggering number, but of course if you look at most of the tech companies, they are pretty much in that margin, and that's why they've been so attractive for the past 7-8 years, and it has pretty much run most of the indexes in terms of tech and the Nasdaq. So it's an asset-light model. Unlike manufacturers, most expensive people infrastructure costs, allowing strong net margin. Now, obviously, the actual net margin is also 30%, which is also staggering. So really, the clear profit they make is outstanding, and obviously helps out with the free cash flow, which I'll come to in a minute in terms of how powerful, how much do they make a year. It's, again, a staggering amount. So why is Meta falling at this moment? Now, several different reasons, always is. It's never just one situation. It's obviously the big one which has worried most of the big tech companies at the moment. Amazon, specifically Microsoft, which, by the way, please do check my last video on Microsoft as well, which is a analysis. Similar situation in terms of AI spending, capex issues. It has increased its capex by $72 billion from even 2025 a year on year. It's currently at $169 billion of capex and R&D on AI. I think very similar to actually Microsoft, I think, which tops the list with $200 billion. Obviously has the effect on that is lower profit short term, and that obviously makes investors fearful. Margin compression has fallen from 48 to 41, so that again has affected the short term numbers. Stock down 22% in 6 months, 24% high. As I said to you, the net income is at $60.4 billion, so it's a 30% margin, margin call. So it's a huge, still making a huge amount of money regardless of the situation. So the valuation is a reset, not a business collapse. So the fundamentals we all know are super strong. So that's a big tick there. There has been also recently, which I think is compounded to the share price falling, the avocado delay, which is this latest Meta AI model Frontier, which was meant to be launched and it has been delayed. Clearly, there's been a few issues, so obviously that's added to the problem there. Again, if some of you want to look more into what avocado is, you can please be my guest. But again, this is again a slight impact. They want, obviously, that's so geopolitical, that's a word, tension obviously has not helped the situation with the Middle East, oil going up, etc., etc. We all know about that. That's well documented at the moment, and I will do a daily show today at some stage about just a recap for the beginning of the week. Now, the other big announcement was, which, I mean, unfortunately I don't like to say this, has had a positive on the actual share price, is the fact that they've reduced the workforce by 20%. That's a potential over 15,000 employees. Now, never a nice thing to hear for people that are individually working and looking for, working there. It has been a common denominator amongst most of the tech companies who have been shedding off staff left, right, and center for the past year or two. So definitely a theme going on there within the tech sector. As I said, I'm not a big fan of redundancies, and we've all gone through that in our various different businesses. As you know, my first business is in the film business. I've been made redundant myself a few years ago, and it's a painful experience for a lot of people who have families and kids. Unfortunately, the way it works with the market is that it does actually boost the share price, means obviously better for the bottom line. Still, not a nice thing to go through for anybody, I'm sure. So while markets obviously efficiency moves, a cut deep can signal that the company is also on the defensive slightly. Well, that's debatable. There's been obviously regulatory issues with various different authorities, like the FCA flagged Meta for failing to block high risk financial ads, adding ongoing legal headaches. Well, I think most of these companies have got legal litigations on the back end of that. So in terms of the bull case on this, now moving on very quickly to why it's a buy, I think, at the moment. And again, I will come to my own conclusion to this at the end of this show at the moment. Strong fundamentals is a tick, as I've just mentioned. Also, massive analyst support. Analysts are currently targeting the stock between $830 to $860. Now, for clarity, the stock price is currently at $593, so that's a huge upside. That implies investors expect a 40% recovery once the market stops panicking about AI costs. That obviously will be the key point to a lot of these tech stocks at the moment, when there's a proof of monetization or proof of profit that all the expansion is starting to bring the money home. And that's obviously going to be a key moment to most of these stocks. And I think most of these stocks at the moment as they stand will rocket back up. Now, that will depend, of course, if they can justify this AI spending, which is obviously the big question mark at this moment. Efficiency, 20% layoff. We've gone through this already. Ad dominance is the big point here. I think the ad dominance for Facebook and various sites is making them a shed load of money. So that is not the problem. So that would be the bull case for why to go in at this moment. Revenue is up 22% year on year from $200 billion last year. Profitability is at $24 billion. Operating income is still strong. Free cash flow, which is a key moment. Now, most of you know that free cash flow for a lot of value investors or people that like that system of trading. Free cash flow is the lifeblood of any company. It's the money they make, which they will reinvest in the business or do buybacks or pay dividends off. And obviously, everybody likes a company with great free cash flow. 43 billion free cash flow, I will say, is pretty damn good. Again, that will also help with the debt, which they have, obviously, like any company. But I will come back to that again in a minute. Well, in terms of highly leveraged, now the company currently is 80 billion in debt. If you calculate the big calculations you need to make now in terms of the payback of the debt versus equity, is that any company that can pay back their debt within 3 years is a good in terms of any value investor. This company, based on 84 billion in debt with a 43 billion free cash flow, which is the money they get every year, can pay back their debt within 1.9 years, which is well within the criteria of any good value investor. So that is a key point, that this company is clearly not highly leveraged, and that is a key point going forward, so bear that in mind. Bear case at the moment. Now the bear case is obviously what is against it, really. AI supercharged ads, WhatsApp monetizing, profit explode. That's obviously the bull case. AI spending is obviously the bear case. I think the main issue here is how is that going to take the company forward with the amount of money they're spending? Will it make profit in the long run after spending that kind of money? We'll see. So that's probably the biggest bear case there. Long term, we'll come to all this in a minute in terms of, obviously, debt is manageable, risk, business is elite, obviously, volatility ahead in terms of short term. That's what you've got to bear in mind when you buy the stock, if you do decide to buy the stock at this moment. Now, the margin of safety is something that we all go... is going to be important, and based on the intrinsic price. Now, before we go to the sticker price, which is $855, I will let you know how I come to that decision. Obviously, it is, based on what you think the growth of the company will be in terms of free cash flow going forward. As we know, the DCF model is all based on the free cash flow, and what it will do in the last 10 years and forward for the next 10 years as well. In terms of the 4 rules, the 4 M's, which I do go on about as well, which is based on Phil Downs' rule 1. Now, again, I've amalgamated all this bit of experience that I like, and I put together in terms of the share price and the company itself. Like I said, it's about the story of the background of the company and the share price. You mix it together, and if it all makes sense and it all falls in place, it is possibly a buy. Now, at this moment, meaning obviously we understand what the business, and understanding the business is the key point here, as we know, and it's been broken down many times by me already. Moat obviously is a pass. Again, this is the actual business, what it is. Is it a number 1 player in its market? Has it got a defense against other companies? Is it the number 1 or number 2 in that market? Yes, it is. Obviously, Facebook is second to none. We all know about Meta and its advertising. It is way ahead of any of its competitors. So it has got a wide moat as far as we're concerned. Management, pass. Obviously, Zuckerberg has turned it around. Yes, there was a few. He is quite aggressive in his way of standing of management. Who am I to argue and even question him as, such that what he's done in his life so far, multi-billionaire, and obviously made the company relevant again after a bit of a wobble, let's be honest, back in the early 20s. I say the early 20s already, time does fly. Margin of safety, we'll come back to that in a minute. So the calculation at the moment, based on the margin of safety, is 31%. Now, what I mean by margin of safety, as you well know, this is coming off the intrinsic price, the true value of the stock based on growth and the DCF model. Now, my calculations at the moment is, I'm going to go through the calculations very quickly, although I have missed all that. There we go. So the calculation at the moment as it stands is $855 sticker price. Now, that's based on a 14% growth of the stock year on year. Now, some people may say it's 12%. Some will be even more conservative at 10, but I believe that the growth based on its average, the CAGR, which is between 12 and 16% growth, it will be around that mark. So based on that and a discount of 8%, obviously you have to discount every year because you don't know how much that money will be worth in 10 years time, so you have to discount it back to 8%, and a terminal percentage, which obviously beyond 10 years you can only do a discount of 2 to 3%. I went with 3%, and any outstanding shares out there makes it 855. So the key point really is the growth bit here, which you can play around with. And depending on that, you could get between $620 to $900 a share. I think that 14% is quite reasonable. Some of you may disagree, and please redo your own margin safety there in terms of intrinsic price, if based on a more conservative or even more aggressive, maybe 16%. At this moment anyway, let's go back. $855, which gives me a 30% discount. Now, my minimum is normally between 25 and 40. Phil Town and some other investors like 50. I think that's very rigid, and you could be waiting for years for a great stock like Meta to go down 50%. However, 30% does give you a slightly more of a margin of safety in terms that the share price falls further. It won't hurt as much. So currently at $5.93, it is at 31% margin. So that is, I think, in the ballpark in that respect. So suggested alerts. So suggested points here, really. Just to recap, really, just to also suggest in terms of alert, in terms of what I think might be a good entry point. Now, the next big entry point would be 40%, which really would be amazing. I think if you can get Meta at 40%, would be 520 to 515. Now, whether that falls further down, that will obviously depend on the AI spending, the geopolitical situation with the markets. If there is a further fallback of 5-10%, you could be definitely looking at around that mark for Meta. I think that you should probably track it currently, even if it was to at 575 to 550, it would be even pretty not bad. It would be about 35 to 40% discount. I think that's a pretty reasonable amount. Obviously, super duper 50% discount would be 430 to 425, as it's stated there. Whether it falls back to 520, that's, I think, very debatable. I think if you could get it anything between 550 and 580, I think that would be a very reasonable price. Maybe buy small amounts to start off with, and then increase your tranches as it falls back by 5%. So if you were to buy at 580 and it dropped to 560, I would buy another tranche and another tranche and so forth, which is, I think, the best way to stagger your losses. And it's also a risk versus reward there in that respect. So, just a takeaway of all this, really, business-wise, it's elite. We know that. Big issues is AI spending. Debt isn't a problem, as we've gone through all this. WhatsApp and AI are hidden growth engines that could massively expand the revenue in the next few years. I think that's a key point. With the amount of users they've got for WhatsApp is staggering. It goes into billions, so that could be also tapped into. In terms of using Rule 1, it checks out on all 4 M's. Margin safety checks out at currently 30%. You could probably get it for even more if you maybe wait around. I still think 30% discount on someone like Meta is outstanding. I think very similar to Microsoft in that respect. And if you are a long-term investor, so if you go for the long haul, this is obviously a serious opportunity to buy in. Now, in terms of short-term, if you're looking at 2 to 6 months, you could also make quite a good profit. I am a value investor, but I am a value investor within reasons. I can hold a stock for a year, 2 years, to maybe even 6 months to 3 weeks, 5 weeks. It depends in that respect. Michael Burry actually is quite similar in that respect. I think he will hold on if he needs to. If not, if he feels that the price is overpriced very quickly, you sell. I think it's an interesting situation. I think Meta is possibly one of the most undervalued stocks out of the 7. It is currently, if I'm not wrong, have a look at the P ratio, around 20 to 22 P ratio. Against, nevertheless, I think it's in line with its sector as well in terms of PE ratio. So I think going forward, at the moment, I would certainly be careful of the markets. The markets are very volatile at the moment, so I would certainly track this. My thoughts is I would probably start looking at buying around the 575 mark. I think that would be probably the most reasonable price. It would be in that 30 to 35% discount. The only reason why I'm saying this is obviously Adobe was one of the examples when I bought too early, too quick, around the 10-15% mark, and it kept falling back to nearly 50% now, so that did hurt. If I had bought it at 30%, maybe 35%, it would have been another 15% loss only at this stage, if you can follow what I'm saying. So I think from that point of view, it certainly is, potentially a better buy, and track that. Now, if it was to go back the other way above 600, would I buy? you probably could squeeze it at 25%. But the margin really at the moment is between 550 and 600 would be probably the better territory. As a company, you can't fault it. It's definitely, if I at the moment, I'm quite stretched with my portfolio, so I am going to sit on my hands. But if I had the cash right now, I would certainly be looking at Meta very, very closely. So, in terms of just finish this off, really, the beta, which is the volatility of the stock, is above 1. So be careful with that as well. There's no short interest at the moment, so the stock is not majorly shorted at the moment. And I think based on the fundamentals, it is second to none. So make what you make out of this. Please do your own research. Please do your own analysis on this. I think it's definitely worth probably a further search. But that is my analysis currently on Meta. Hope you enjoy. Please smash the like button and subscribe. It would be much appreciated. And I will be back later today with potentially a daily recap of the weekend. It's all been going in the market, as we know. Actually, before I go, just to kind of give you a quick idea there of the chart at the moment, and this is the chart I've actually compiled. It gives you a little bit more of a clearer thought on my own platform at the moment, and you can see that it's well above its 200-day moving average at the moment. The 50-day moving average is just below that at the moment. So there you go, and it is momentum-wise very much on the oversold side. So I think based on that, I think you should probably sit on your hands a little bit longer and wait and see where the market go. So on those wise words, it's Trader72, and please, any comments, any question, please ask below. Always happy to answer your questions, and I will see you soon. Over and out, Trader72.